Illinois. I'm glad you're able to attend today. Our topic for this afternoon is investor tax strategies. We're going to focus on helping you keep more of your hard-earned investment dollars. I generally feel that most people are overpaying their income taxes, and if I can share with you today a couple of investment strategies to help you keep more of your own money, then we'll have a mission accomplished. We will be taping this recording, and you'll be able to take a look at it in the future if you'd like. If there's something else you have a question about, at the end I'll give you my phone number and email address. You'll be able to get a look at it that way, so you can call me to follow up. We hope to take about 15 minutes of your time, no more than 20 tops, so it'll be brief, but we'll get right to the point. Let's start with a few things we're going to talk about today. One is going to be capital gains. One is going to be Medicare surtaxes. And then the last will be tax strategies. I'm going to go through 5 major tax strategies. I want to start off by mentioning something that happened last year. The capital gains tax rate was raised for people in high income brackets. They did that as part of the Affordable Care Act, Obamacare health plan, to try and raise money. For people, individuals over $200,000, their capital gains rate is going from 15% to 18%. Rather than doubling that, they'd create a marriage tax penalty in that married couples that earn over $250,000 will also be subject to the higher 18.8% rate rather than 15% rate. It's raised significantly higher for people earning over $400,000 as individuals, as that rate's now 23.8. And for couples, again, it doesn't double, so that's a marriage tax penalty. If they make over $450,000, they're subject to the much higher capital gains rate of 23.8%. Not only is this a larger tax burden for those people in the high income brackets, but what I think it really signifies is hang on to your wallet. This was done to help pay for the new Health Care Act. It'll be interesting to see how that all plays out with whether or not they raise the money they were hoping to raise to pay for that program. That's 1/6 of the entire economy. Not to mention the overall tendency of the government to want to tax us more. That's why these strategies are even more important than ever before. You need to do and take advantage of strategies that are already available to save as much as you possibly can in income tax. Another tax that started is an increase in the Medicare tax rate. Now, if you're going to have, if your income's over $250,000, your income is now taxed from a Medicare tax, not at 1.45, but all the way up to 2.35. Now, as a percentage, that's a huge increase. It's not quite double, but it's over 50% increase. So heads up for that. If you're a single person, if you make over $200,000, that new tax applies. This new Medicare tax rate also is included on investment income from taxable interest or dividends, rents, annuities, capital gains, all those things. So Uncle Sam's going to be knocking on a lot of people's door for more money here in the coming years. Now let's jump into the strategies. I'm going to go over 5 strategies here today. The first one relates to capital gains. With capital gains, you have something called a unrealized capital gain or unrealized loss. We're going to focus here on the gains. You need to find out what your cost basis is first and foremost. How much did you pay for an investment? That includes not just your initial investment, but any other future contributions you made, as well as if you have mutual funds where you're reinvesting the dividends and capital gain payouts that come every year, that money is used to buy more shares and figured in your cost basis. The good information, the good news is that now brokerage companies are required by law to include your cost basis information on your statements. For older investments, for example, I had a client call me 2 weeks ago. She inherited some Commonwealth Edison stock. She actually had the certificates that she got from her mother. However, they're so old, Commonwealth Edison stock doesn't trade anymore. It was taken over by another company, Exelon. So we had to call the Exelon investor relations folks to dig in and help us figure out what the actual cost basis was of those certificates so she could make a decision if she were to sell them, what the tax situation would be. You don't want to undermine your long-term investment strategy just because of income tax. I have people that have had long-term capital gains and they're in the 6-figure amount, there's no reason to sell necessarily now and pay all that capital gains tax if you don't have to. If you do have assets that have gone down in value, you may want to look to sell those if they don't fit your investment strategy. I've got other clients who have owned things for years before they met me even that are now worthless investments, but they're having a tough time parting with them. Go ahead and write those off. You don't even have to physically sell them if they're worthless, and you can take advantage of the tax loss. In any case, when you are selling investments that happen to be at a loss, you cannot buy back the identical investment within 30 days. So heads up for that. You can buy something similar, but you cannot buy the same thing. So you want to look into realizing the gains on some winners. Why would you want to do that? Why would you want to take advantage of that? Well, let me give an example. Back in 2008 or 2009, some people lost significant chunks of money. Let's say you lost $20,000 because you sold out of an investment. And then you went ahead and took that money and you bought something else that actually went up in value. And then you look on your statement today and you have a $20,000 investment as your cost basis that's now worth $40,000. Well, that'll be listed under unrealized capital gain. It becomes realized if you go ahead and pull the trigger to sell it. So if you sell that investment and you have a $20,000 gain, you don't have to pay any income tax on that investment if you have a loss equal to that amount. So you could take the $20,000 gain and net it against the loss and end up paying zero tax. If you have losses greater than that, say you had a $40,000 loss with a $20,000 gain, where you can take the $20,000 as an offset, and every year the government allows you to use an extra $3,000 of that loss. So you couldn't use the entire loss in that example, but you could use an extra $3,000 per year. And then if in the future years you have a larger loss, a larger gain, and you want to use that loss to offset it, you can do that as well. So the idea here is it's okay now to sell winners, especially when you have old losses that you've harvested in the past and you've not used yet. Another tax strategy that you should look into is something called a bond swap. This is very similar. For years, as interest rates have been going down, bond prices have been going up. Includes on your bond mutual funds. However, this year, the table got turned momentarily. If you bought $100,000 into a typical bond fund, you would have seen a decline, a significant decline, as in the summer and the fall, interest rates quickly spiked up. The 10-year Treasury note went from about 1.6 to about 2.8%. It seemed like overnight. It was very quick. It was a large percentage drop, and people saw their bond mutual funds or bond prices drop rather quickly. A $100,000 investment dropped down to $94,000 in value. And if you were savvy enough, you could have sold either at that level or today that value is probably not higher than 96. You could sell that investment and take advantage of the loss like I described earlier. When you do that, if you want to stay with your general asset allocation principle and say, for example, you want to sell this bond fund, take advantage of the loss, well, you could turn around with those proceeds and rather than buy the same security back 30 days later, you could turn around and buy a similar security. This is the idea of the swap. You'd swap, for example, a Treasury bond fund with a AAA-rated corporate bond fund. No, it's not the same investment, but it'll react very similarly in your portfolio. So this is a bond swap. It allows you to take advantage of the loss for tax purposes, but not really affect your overall asset allocation mix at all. So you need to review your statements. Ideally before the end of the year. You don't have to wait till the end of the year, but before the end of the year for sure you want to look at this. Now let's talk about a strategy that works long term. The idea is tax reduction above the line. So where do you put your money? I'm not talking here about asset allocation. Asset allocation is what percentage do I put in stocks, what percentage in bonds, what percentage international, etc. What I'm talking about here is if I have a choice between holding my stock mutual fund money or my bond mutual fund money in my IRA or 401k as compared to my taxable account, where should I put it? Well, it depends on how those vehicles are taxed. That's the determining factor. And knowing this and acting on this can make an annual difference on your returns of at least 0.5% a year because that's the money you save in taxes. So let's look at this in a simple way. the investment asset classes towards the top of this list are not tax efficient, generally speaking. So those you want to place in a tax-free or tax-deferred account. When I say tax-deferred, I mean 401k, IRA tax accounts. You have high-yield bonds, anything that pays out a high dividend or high interest rate. Real estate. This could be foreign bonds. This could be emerging market bonds. Stocks or stock mutual funds with high turnover. If you're going to be a stock trader yourself for fun, maybe you have a fun account, you're much better off doing that inside your IRA, because when you make those gains, say for example you were smart enough to buy Twitter at 45 and maybe you sold it at 55 in a 3-week span. Take that gain inside of your IRA, because if you take it outside of your IRA, that short-term capital gain is taxed as ordinary income. So for many of you, it's going to take a chunk of 28% out of your gain. So it's very hard to make money in the market when you're losing 28% every time you're successful. You do have a short-term gain. Some mutual funds are much more active than others. Mutual funds, by law, have to net their gains and losses throughout the year, and usually come December, they make a distribution out to the shareholders. Whether your account's up or down, if the fund internally made money, you have to pay. So for example, if a mutual fund's only investment happened to be Apple, and they bought Apple at 50, and at some time throughout the year, they sold it at 650. So they had a huge capital gain. If that was their only capital gain throughout the year, they'd have to pass that on as a proportional capital gain to all the shareholders. Now maybe you're the shareholder and you bought Apple in July and the stock price was at 650 and now it's down to 550, so you're going to have actually seen a decline in the value of your mutual fund, and here you get stuck with a capital gain distribution that you didn't actually technically earn. Well, that's what happens in mutual funds that are not tax efficient. So beware of that. What does belong in your taxable accounts? Efficient investments. Investments that don't pay out large capital gains. Investments that don't pay out taxable income, such as municipal bonds, are perfect for taxable accounts because the dividend income is all income tax free. Index funds and ETFs, exchange traded funds, are also very efficient, generally speaking, when it comes to their capital gain distributions. Lastly is tax managed fund. What's a tax managed fund? This is something that many of my clients already have. These are focused not just on the growth of investments, but they really have their eye on the ball when it comes to minimizing income tax payments. Those capital gains distributions I was referring to here, and we'll talk about again later, they minimize those. And it's really important that those types of assets are placed in your taxable accounts. So again, look to have things like municipal bonds and high interest paying instruments put inside your tax-free or tax-deferred accounts. And the more efficient vehicles should be placed in your taxable accounts. Next, we're going to look at some things to do for sure before year end at some point. I've got 3 kids. If you have kids or grandkids, this is for Grandma and Pa too. Illinois has got a great program available. Illinois Bright Directions or Bright Start, they're equal as far as this tax rule goes. I have 3 kids, and they're all I'm saved like crazy in this Illinois Bright Directions plan for them. The contribution I make up to $20,000 a year for my wife and I is tax deductible to my kids. So $20,000 a year times 5% Illinois income tax rate means I'm saving $1,000 every year in state income tax. I think that's pretty significant. Grandparents, you have the same opportunity. If you're so inclined to help out your kids or grandkids with college expenses, this is the way to go. You become the owner on the account, not the kids. It's not their asset. They cannot turn around and buy a car with this. It's for college. When the money's in the account, it grows tax deferred. When it comes out, if used for college, it's tax free. Especially for the grandparents, this is of interest. Some grandparents hold off on making these contributions because they're concerned they may need this money one day. One of the nice things is they could stay the owner on the account, and if they need it for their own personal use, they can go ahead and take it for that. They have to pay a small penalty on the growth in the account, but it's really not very significant. Something they ought to really look into. So that's $1,000 of the savings I promised. Another one that I use is a health savings account. If you have a high deductible HSA qualified medical insurance plan, all the new bronze plans under the Obamacare health plans, the bronze ones are generally HSA qualified. You put money into a separate account that can be used for medical expenses tax-free. There's no income limitation. So whether you make $20,000 or $200,000 or $2 million, there's no income limitation. You get a full write-off. So as a couple, I make a check, or I pay a little bit every month. I get to my $6,450 in a year. I subtract that like the old school IRAs. $6,450 comes off my taxable income, which saves me a little over $1,800 a year. That amount's going up every year. The $6,450 used to be $6,000 or less than that. It continues to rise. Not only is it tax deductible going in, but it grows tax deferred. I've got over $30,000 in my account. I've been putting in now for 6, 7, 8 years. That money's been growing. You can invest it in mutual funds or stocks, even if you're so inclined. And also, when it comes out, this is another great catch. When it comes out, it's tax-free if used for medically approved items. So this is really a win-win situation. I'm using this account. I think it's one of my most important retirement vehicles I have. I'm going to have over $100,000 in this account if I keep going the way I am, that I may use for an artificial hip or, who knows, a new knee or something, but I'm not counting on the government to pay for these things. I'll have the money myself ready to go on a tax-free basis, and you might want to do the same. Last strategy, again, I want to focus on, it's not what you make, it's what you keep. This graph shows $100,000 invested years ago, 1970, 78, and it's a 33-year graph, and it shows that there's a whopping difference if you consider all the money that comes out through the taxes, and that difference grows significantly over time. You don't think about it because it's a slow burn on the difference. This shows almost half the money lost to taxes over that 33 years. How does that happen, you might want to know? Well, for example, this year, the American funds, the Growth Fund of America is paying out 6% in capital gains. Two other funds, Investment Company of America and the New Economy Fund, both huge growth funds, large company growth funds, are paying out between 5 and 7% of their money in capital gains. Well, what this results in is distributions that are taxable to shareholders. As my example shows there, if you had $250,000 in a mutual fund that paid out a 6% distribution, you're talking about $15,000 of taxable distribution. At the 15% tax rate, when you multiply that out, you get $2,250 in capital gains tax. So that's a lot of money. Now that would only grow in the future. As your account grows in value, that number is going to grow right with it. To contrast that with one of the tax managed funds I mentioned earlier, one of the ones I use is a large company fund managed by a firm called SEI, and its eye is on trying to minimize income tax. And in trying to do that, they've been so successful that 14 years in a row they've had zero capital gain distribution. That's not to mean that their account has not grown substantially over the last 14 years. It has. But they have someone who's watching all the different investments and actively coordinating the sales to match up the losses with the gains inside the account. There's probably over 100 holdings in those accounts. And zeroing out those capital gains so that come December, unlike many of the other accounts or the American funds and many other ones as well, they've done a great job in minimizing those distributions. So if you had the hypothetical example, those two lines would be even or close to even if you're in a tax-managed account. And that's what we mean about it's not what you make, it's what you keep. It's a real shame to have all that money lost to taxes. So hypothetically, if all that money on the blue line was in an IRA, that's what the balance would be. But if that same investment account was in a taxable situation, you'd have roughly half of that money. So keep this in mind next time you're investing. If you have questions about how to do this, again, let me know, because I think it's of great value, and I know a lot of my clients have loved this situation. Lastly, before you do all this stuff, take advantage of any of these things, make sure you do consult with your tax advisor to make sure that these strategies are appropriate for your situation. That's absolutely critical. You can call a CPA, you can call my office, I can help you as well. In closing, I want to thank you for listening today. Don't wait to get started. Don't wait till the end of the year. I know a lot of people progress in doing so. They miss out on some of these tax-saving opportunities. You can email me. The email address is Brad at Fortune Financial Group. You can call me, 630-942-9007. I have a really great opportunity for you if you haven't downloaded this already. 9 proven ways to minimize income taxes. I don't think I've paid a dime in capital gains tax as long as I can remember. I paid very little in dividend income tax. Why? Because all of my money is sheltered in different vehicles. These are two of them I've mentioned today. I have several others that you ought to be looking into as well. This free ebook is yours by simply going to my website and downloading it. You'll find it at fortunefinancialgroup.com. You'll also find it on my blog, lifeplantoday.com. Please feel free to read that, send it to your friends, etc. Also now on my blog page, I'd like to strongly encourage you to look at the right-hand side. I've started to tweet. Now don't get too worried about tweeting. It's not just for kids anymore. The Twitter account is my newspaper. I follow a number of key information resources, and I take that information and I put it on that area so that you can take a look at the articles that interest you, and I think you'll find some of them extremely beneficial. It's a great way to filter through all the financial information out there and focus on interesting articles. Also, obviously, you can like us on our Facebook page. Again, I want to encourage you all to call me or email me if you have questions about this information as it relates to your personal account. I am going to be recording this video, and I'll be getting it up on the internet before too long. If you'd like to watch it again, you're welcome to. If there's some sort of concept you want to share with somebody else, feel free to do that. Thank you all for listening. I appreciate your time, and I hope you have a great year. Take care.